All right, so let's go ahead and get started. Excited to give again a brief overview of the private mortgage fund industry. A lot has changed over the last 24 to 36 months, especially since we launched our mortgage fund. I was actually on the phone with one of our investors about a week ago, and he had mentioned that we hadn't put on a presentation like this in a while. We've been doing a lot of kind of individual presentations that we've brought in outside vendors to talk about kind of some of the legal aspects that have been changing in our industry, but again, haven't really kind of covered generally what is going on in the mortgage fund industry, and just talk about how mortgage funds are created and why they make a compelling investment in today's rising rate environment. So today, the participants that are going to be here are going to be people that may have already been invested in mortgage funds, that maybe have invested in trust deeds, and maybe not have invested in either one, are just interested in learning about the mortgage fund industry. In these presentations, I'd like to have it more collaborative and not just me talking to you and talking about whatever subject we're talking about that day or today. If you've got any questions or comments about what I'm talking about, please feel free to use the chat button, and I'll get to those questions throughout the presentation. I always tell people, I promise you, if you have that question, somebody else has that question as well. I've been doing this for over 15 years, so I do have a tendency to kind of get into the weeds on things. And if it's something that, again, you don't understand what I'm talking about, please feel free to drop something in the chat session. So with that, my name is Brock VandenBerg. I am the president of TaliMar Financial and the fund manager for TaliMar Income Fund 1. And today we're going to talk about investing in private mortgage funds. Quick disclaimer, this presentation is not an offering to invest, rather it is an educational webinar. If you're interested in investing, you'll need to request the private placement memorandum and related subscription documents. Also recommend that you speak to your CPA, attorney, wealth manager, someone that might be handling your day-to-day finances to see if this is the right investment for you. I always kick this off as private mortgage funds are on the riskier side of investing. Anytime you invest in something that is earning returns in the 8, 9, 10, 11% range, anticipate there's going to be some risk associated with that. So with that, here's a quick overview of what we're going to talk about today. First, I'll give you a little brief overview of TaliMar Financial. We've been around for 15 years. I'll talk a little about kind of our progression in the private debt industry. We'll talk about what is a private mortgage fund. So what is it from a macro view standpoint? We'll talk about why especially in today's rising rate environment, it makes a compelling investment for people that are looking for a fixed income investment. We'll also talk about how to evaluate a mortgage fund and make sure that the mortgage fund that you're interested in kind of meets your criteria. No two mortgage funds are the same. Many fund managers look at the industry very different. They target different target loan types, they target different markets. So you want to make sure that if you do decide a private mortgage fund is the right investment for you, you want to make sure that it kind of aligns with what you're looking to invest in. Once you invest, it doesn't stop there. You need to still be involved in understanding the direction of the mortgage fund, the performance, the health of the fund. We'll talk about what you should do once you're invested. After that, we'll then just give a brief overview of TaliMar Income Fund 1, our fund. So a little about myself. I am a graduate of the University of Michigan. I'm super excited, yes, that we won the football national championship. Unfortunately, we did lose our coach to now the Los Angeles Chargers and not the San Diego Chargers, which was my home pro team, but unfortunately lost them to Los Angeles. I've done post-college coursework in real estate finance and accounting here in San Diego at the University of California, San Diego. I actually got started in the real estate finance industry in 2001 as a financial analyst for KeyBank's private equity group. Essentially, I was the guy that was sitting behind spreadsheets and doing spreadsheets all day long. Really what we did is we provided what's called mezzanine debt or joint venture equity to real estate developers. We essentially came in as a capital partner to them. It was a great investment or a great opportunity to learn all about the residential finance industry all the way up until about 2008 when things all collapsed. And was actually the catalyst to why I started what is today TaliMar Financial. I did spend 2 years with the FDIC after KeyBank. If you've ever saw those videos about the FDIC going in and closing banks down, I was part of that team. So as a bank was failing, the FDIC would send a team out at Friday evening at 6 o'clock. We would come into the bank. And I always say, like, equated to like ants. We just tore it apart, sold off its pieces, and then following Monday, either we had an acquiring bank come in and take it over, or the FDIC came and took it over. But it was up and running Monday morning. As much as you want to say that the government doesn't work efficiently, I had a wonderful experience at the FDIC. I worked with some of the smartest people that I've ever worked with there at the FDIC, and under an immense amount of pressure back then. It's funny, it's kind of coming all full cycle now. You're starting to see some of the banks nationally, especially the small banks, having to be taken over by the FDIC or acquired by other banks. We saw Synergy Bank, Silicon Valley Bank, and a couple of others. And you'll probably see some more smaller and regional banks who've been heavily impacted by the problems in office on office loans. So I anticipate that here over the next, I'd say 6 to 12 months. I did establish TaliMar Financial in 2008, really kind of stumbled into it. I was down at a real estate networking event one night. Somebody who was buying houses at the foreclosure steps. They didn't have cash at the time to buy the houses, and I just started lending them money to buy homes. And that's kind of how it started. It wasn't some big idea that I had. Found out that there was kind of a business behind it, lent all my money out. Started to talk to my friends and family about what I was doing and the returns that I was earning. They got involved in alongside me investing in what we call trust deeds, or essentially individual loans. Did that all the way up till about 2021. I got up to about 50 million in total loans, and then we launched TaliMar Mortgage Fund, which was what we manage today, which is TaliMar Income Fund 1, and that is what we lend out of today. I have a California mortgage broker's license, and I did earn the certified fund manager from Gerasi LLP, which is one of the larger law firms that focus on the private mortgage fund industry. They're actually our attorney. They're the ones that put together our PPM and financial documents for the fund. They provide a great educational platform. They want to make sure that their clients understand how to run a mortgage fund, and they put you through a certification program. And I had the opportunity to be one of their first students through that program. And if anyone is familiar with the American Association of Private Lenders, also known as AAPL, they meet once a year. Highly recommend going to the event. Brings in everybody within the private real estate debt space together for one big event, talk about what's going on in the industry, educating everybody, because this is a quickly changing environment and quickly growing environment. My family last year, Hawaii, we're actually heading out here in the next month. My beautiful wife and 3 kids. Yeah, that's a lot. It's a lot as a parent, as a father. I am learning a lot about how to parent. As I mentioned earlier, we established TaliMar Financial back in 2008. Give you some idea of kind of business that we've done since that period of time. We funded nearly 1,000 loans, totaling over 460 million in loans. We currently service on behalf of the fund and then also private investors 111 loans, totaling over 86 million. We are located in San Diego, California, and have 9 employees, and actually adding a new employee here soon. This is my staff. To the left at the top, you got Sarah Zybura. She's my director of operations. She's been with me for almost 10 years. She handles day-to-day operations for the organization. I have two loan officers, Brandon Warnke and Blake Maelstrom. Brandon handles bringing loans in on the San Diego market, and Blake up in the LA market. Megan Jacobson is our loan closer. Jermelyn Navarro handles and assists kind of the loan servicing and investor relations. Adela, our incredible marketing director. Chris Escobar does the loan processing, and Susan Jones. If you're currently invested in the fund, you've probably spoken with Susan Jones. I need to get her on for an interview. I know she did a video about a week ago to do a quick introduction. So Susan does a wonderful job as our fund continues to grow. She's the one handling all the incoming investors. So great job, Susan. So let's go ahead and jump into it. Again, I want to kind of give a 30,000-foot view of really what a mortgage fund is, what, the inner workings, why it might be a good investment. So let's just talk about what is a mortgage fund. And essentially a mortgage fund is just a collective investment vehicle that pools investor capital together and then lends that money out. For those that have invested in trust deeds, imagine a much more diversified approach of investing in trust deeds or mortgages. So when you invest in a mortgage fund, it holds a bunch of loans and it's constantly funding new loans as old loans are paying off. And all that interest income that the borrowers are paying gets paid to the mortgage fund and then gets paid out as distributions to the investors. Now, those distributions can be monthly, they can be quarterly. It's all based upon how the fund manager sets up that fund. But what's really unique, or what's interesting about investing in a fund, is that you're invested in a diversified pool of mortgages. So, if one mortgage goes bad, it's not like your investment goes belly up. You've got all of the other loans that are performing in the mortgage fund that are still paying interest to you as the investor. Now, in a private mortgage fund, and you always kind of want to highlight this, is that it is what I call fairly liquid, right? So you, in order to, once you invest, your funds become active, and they essentially become active in all of the loans that mortgage fund invests in. But in order to get your money out of a mortgage fund, essentially one of those loans has to pay off, and then the proceeds are distributed out to those investors that want to withdraw their funds. Also happens if new investor capital comes in, can also be used to manage withdrawals of a fund. So what does it really look like? Well, if you notice here on the, let's see if I can get a pointer going. On the left-hand side are the investors. Okay, so here, these investors all invest in the mortgage fund. And I always equate the mortgage fund like a bank. Now, it isn't a bank, it isn't FDIC insured. I'm just using kind of an analogy here. It's like a bank. And then borrowers, in our case, real estate investors and operators, will reach out to us for a mortgage. And I'll explain why they reach out to a mortgage fund versus kind of not go to conventional lenders, but they reach out for loans. And so we fund their loans just like a bank would. And just like a bank, a mortgage fund records a deed of trust on the property, and that borrower makes payments, in our case, every month to the mortgage fund. The mortgage fund then processes those payments and distributes those in the form of a dividend out to the investors. And investors can choose to take those monthly distributions and keep them, or they can reinvest the distributions back into the mortgage fund and earn compounded interest. What's great about most mortgage funds is that you can invest personal funds and you can invest retirement funds as well. So you can use both. And what we've also found is that the popularity of these private mortgage funds have caught the eye of large custodians, especially like Charles Schwab, Fidelity, and others, where now you can actually invest through your retirement accounts on one of these platforms. So we've been approved on the Charles Schwab and the Fidelity platform. You can actually use your retirement funds on their platform to invest in our mortgage fund. And the reason why these larger custodians who even like 5 years ago probably wouldn't have ever been interested in custodying these kinds of investments is that the popularity of just alternative investments has ballooned. And in an effort to retain their clients, they had to create a platform for their clients to be able to invest in alternative investments. And one of those alternative investments that has increased in popularity are private debt funds. So again, to kind of overview here, you, the investor, are investing in the mortgage fund. You have a secured interest in that fund. That fund then lends money out to real estate investors, short-term loans. Those borrowers are then distribute those funds or pay those interest payments back to the fund, which is distributed back out to the investors as dividends. Okay. So key terms that I'm going to use, number one is the private placement memorandum, also known as a PPM. Essentially, it's a document that details essentially what you're investing in. It's like it's a massive manual, easily over 150 pages. I can show you our mortgage, our PPM here is this right here. It's a thick document, and essentially provides all the rules and regulations that I have to follow when I invest the money in this mortgage fund. So number one, it's always important to grab that PPM. There's a lot of legal jargon in it, but there are a number of pages that you should obviously take into consideration when reviewing it. Number one, what is the focus of the mortgage fund? And what kind of properties are they lending on? Loan to value ratios, owner, non-owner versus owner occupied properties. And usually that's right on the front page of kind of what that mortgage fund is investing in. Number two, you got your subscription agreement. Essentially, this is the contract between you, the investor, and the fund, stating that you are investing in the mortgage fund, that you are purchasing shares of that fund, and you're committed to investing. And then again, further details what that means in terms of an investment. Fund administrator. So a lot of people get confused with a fund manager and a fund administrator. Essentially, what a fund administrator is somebody that is a third party that manages the day-to-day accounting of a mortgage fund. Think of a third-party accounting firm. But they kind of take a step even further. They're the ones that do investor reporting, and they're the ones to ensure that that fund is meeting security and compliance SEC regulations. A lot of third-party fund administrators, or a lot of funds use third-party fund administrators because number one, it's very costly to have somebody like that on staff. But second, a lot of the investors who are investing in the mortgage fund prefer to have a third party handling all the accounting. Kind of puts another set of eyes to ensure that the accounting is done correctly. And then the fourth item we should always talk about is accredited investors. So most mortgage funds, I'm not saying all, but most mortgage funds do require that you are an accredited investor. So that means you have at least a net worth of $1 million or greater. That the other items are, you have an income threshold. I think it's like 250 individual, 300 married couple. That you are actually qualified to invest. And I think a lot of people are confused with why they want that. Again, these are complex investments. These are things that really, if you should have or the capacity to be in a position, if you were to take losses, that you're not going to get fully wiped out. This is why the SEC really is very detailed in who they want to be invested in the mortgage fund. So common questions I get in terms of that we get in people that invest in the fund are, distributions. How are they made? When are they made? So again, in a mortgage fund, when the borrowers start to make payments, that mortgage fund processes those payments and makes distributions either on a monthly or quarterly basis. If you're investing in trust deeds, you're probably used to getting a 1099 at the end of the month. In this case, you actually get a K1. And then another common question is, again, what am I actually secured with when I invest in a mortgage fund? Unlike a trust deed or a mortgage where you're secured directly on the property, in a mortgage fund, you're actually secured through a subscription agreement, and you become essentially a shareholder in that mortgage fund. So let's talk about some of the compelling reasons why people are investing in mortgage funds and why some of the biggest wealth managers, private equity funds, investment banks have moved a substantial amount of cash into the private real estate debt space. First and foremost are interest rates. So interest rates have jumped, okay? The 10-year treasury has jumped from 0.5% on its low in August of 2020 to I think this number is today to 4.28%. So the returns a mortgage fund earns have jumped considerably. When we first established our mortgage fund back in 2021, we estimated a return of around 7%. Now, obviously today, that doesn't seem like a very strong return for a fixed income investment. But if you were to talk about 2020, was a pretty solid return for a fixed income investment back then. Well, today we're earning approximately 9.5% year to date in our mortgage fund. So now it starts to become a very compelling fixed income investment, especially for people that are looking for consistent monthly income and looking for liquidity as well. Number two, local and regional banks have pulled back their lending. So over the last, I'd say 18 to 24 months, where we've seen that large amount or the increase in interest rates, banks have started to increase the amount of liquidity that they have on their balance sheet. And as they increase the liquidity they have on their balance sheet, that reduces the amount of liquidity they have to lend out. In fact, what we're actually seeing is a lot of local and regional banks shifting their lending focus from actually individual borrowers, so investors and real estate investors and operators, to actually mortgage funds. So I get calls every day from banks asking if they can provide us a credit line. And they would rather provide credit lines to debt funds than directly to borrowers because it's a much safer and easier loan for them to do. And they can provide much bigger loans and they're easier to manage. So what has happened is as local and regional banks have pulled back the lending they've done to the real estate investors, developers, and whatnot, the private debt funds have filled that space. Now, the money is a little more expensive, but for a real estate investor, they're willing to accept a little higher interest rate if it means that they can transact quicker, that they have less required documentation upfront to get approval, and most importantly, that they don't have to make deposits. Most of these local and regional banks are requiring deposits when they do loans with a borrower, usually around a quarter percentage of that loan amount. A debt fund doesn't have those covenants. So a lot of developers have shifted from getting money from a conventional bank to debt funds. It just kind of shows you the demand out there for our kind of capital. And then I'm going to go ahead. I see a couple of questions come in. I'm going to go ahead and get to some of these questions at the end of this presentation. So let's talk about real estate values continue to climb in supply-constrained markets. So obviously, we're seeing some concern, especially within the multifamily investment sector, that there's concern that values either have plateaued or coming down, and that becomes an issue for people that are real estate developers that have bought multifamily projects to reposition, can't get refied out of them because interest rates have climbed so much that they have to actually put cash in to meet the underwriting guidelines of a takeout lender. So, but in a lot of markets, especially urban markets here in Southern California and throughout California, real estate values continue to climb, and it's because there's a supply-constrained markets. Here in San Diego, we woefully underdevelop the amount of homes that we need for the amount of people that are coming into San Diego. You have the same issue with Orange County, Los Angeles, even the Bay Area as well. And so, as local and regional banks are pulling back their lending, many of these city governments are really pushing new development. These local real estate developers are having to go to private debt providers like us to get the financing they need. And that's why we see a significant increase in the demand for financing. Obviously, number 4 here is a high yield fixed income option. A lot of investors out there, especially retirees, are looking for a high yielding fixed income option. The private debt space certainly offers that platform. The other thing that a lot of investors, especially our investors, are interested in learning about or interested in our fund is the ability to kind of invest in properties, but without having to actually buy the property. So kind of I always say the next best option when investing in real estate is actually just be the lender. Okay. You don't have to deal with identifying the property, buying the property, managing tenants, selling the property. In fact, we see a lot of investors right now choosing to sell off their property portfolio and just move it into private debt, because they can earn actually a higher month-to-month return on just being the lender than actually owning that property. Obviously, there's some real tax advantages of owning real estate, but if that's something that's not of big interest to you, the second best option here is investing in private debt. And so you can invest in single family, multifamily, industrial, commercial, these property types by simply being the lender. And you're not dealing with the issues with being a property manager. You can also invest in the regions you want to invest in. So with the huge proliferation of private debt funds, you can invest in Southern California or choose to invest in the Northwest or Midwest or Southeast, because there's a lot of debt funds that focus in these core regions. Also, you can look at debt funds for risk-averse returns. And as I had mentioned earlier, not all debt funds are created the same. Some take higher risk to get higher returns. Some take less risk, get lower return. And then obviously there's manager experience is something that you have to take into consideration when investing in a fund. But there's some really highly experienced fund managers out there that are launching new funds. And then the last piece is your ability to use retirement funds to invest. As I had mentioned earlier, a lot of custodians like Schwab and Fidelity and others have opened their platforms to alternative investments, one of them being a mortgage fund. We were approved on the Schwab and Fidelity platform. And so it's much easier today now to invest in these alternative investments using your retirement fund than it was just a couple of years ago. Back then, we would have to work with a third-party IRA custodian, if you probably remember. And then it's still a very popular choice to use a third-party custodian. But if you're already a customer of Schwab or one of these custodians, there's no real reason to move your funds into a third-party custodian. If you're not, though, a third-party custodian is a great option to get invested in these alternative investments. If you do need names of third-party custodians that you can use or that you can invest in these kind of alternative investment with your retirement funds, please feel free to reach out to me. There's a couple of local ones that I've worked with that are just wonderful to work with. Now, with debt funds, there's been kind of a new component to debt funds that over the last, let's say, 5 years, has become a popular choice. And that is the REIT, the Real Estate Investment Trust. A lot of us probably heard about these, generally about investing in REITs, but a lot of mortgage funds have transitioned into a REIT structure. And there's a couple of reasons why that's important. Number one is that it qualifies investors for the 20% qualified business income tax deduction. I'm not going to go into the weeds on this, but it had something to, it came out of the 2017 Jobs and Tax Act, and allowed essentially business owners to take a tax deduction from the income generated through a pass-through entity. And well, what was great about this is that it did encompass REITs. So the income that's generated from a REIT qualifies you regardless of income in most cases. And you'll want to talk to your CPA to see if that you qualify for this before investing, but you get a 20% tax deduction that comes out of a mortgage fund structured as a REIT. I'd be more than happy if you want to reach out to me and explain that more or share more information on that. But definitely, that's probably one of the top 5 reasons investors invest in our mortgage fund. Number 2, no unrelated business taxable income, called UBTI. So if you use your retirement funds to make an investment in a debt fund, and that debt fund uses leverage, you may be subject to taxable income based upon the percentage of leverage that that investment used. Now, with a REIT, on the other hand, you're not subject to UBTI. And I think a lot of investors who use retirement funds are not aware that they are subject to taxable income if that fund or if that investment uses leverage. But again, if the fund is structured as a REIT, you are not subject to UBTI taxable income. For more information on that, I would highly suggest you talk to your CPA. It gets very complicated. Also, a REIT eliminates state tax withholdings. So when you invest in a fund that's structured as a REIT, unlike mortgage funds where if you're here in California, invest in Texas, Oregon, and all those states, you may have to file income taxes in each one of those states. The same thing with, we have a lot of investors in Nevada, in Arizona, and Florida who don't want to be subject to California withholding tax. Well, that REIT eliminates that withholding requirement. So you're only having to file in your home domiciled state. And that's another big component for high net worth and family offices that want to invest. So who is invested in private mortgage REITs? Well, almost every major investment bank is now invested in the private mortgage funds. And it's because of the returns that they can earn. And number two, because of the massive market. And we're talking billions of dollars are flooding into this private debt space and filling this void that local and regional banks have kind of left as they've pulled back the lending that they're doing. It's huge. So this is a great article on Reuters. I can share this article. There's been some other articles about how much growth there is in the real estate debt space. And again, I think that the banks are treating this or kind of focused in two ways of doing it. Some are trying to create their own platforms for doing the private debt, but many are providing the credit lines to companies like mine, debt funds like mine, to get invested, but not having to originate and manage the loans. So you're seeing, again, a big popularity or seeing a big push by these banks to get involved with private debt funds to provide credit lines to them. Here's some of the other big banks that we see out in the marketplace: Goldman Sachs, BlackRock, JP Morgan, Merrill Lynch, Nomura. All have their own platforms in the private debt space, and they're extremely aggressive about growing their market share, especially here in markets like San Diego and LA, where there's just so much opportunity right now to deploy capital into the private debt space. Here are the top 5 reasons why investors invest, or people, when they come and invest with us, these are the top 5 reasons they tell me. Is number 1, it offers consistent monthly income, or it offers consistent quarterly income. Our fund provide or distributes monthly, but a lot of funds will also distribute quarterly. But what that is a quarterly income. And again, I compare that to kind of owning maybe a single family or multifamily property where you're constantly getting that income from the property. Investing in private debt kind of offers the same idea. Number 2 is the security of real estate. At the end of the day, if you're investing in trust deeds or a mortgage fund, the underlying security to your investment are the loans that are secured on the real estate. And assuming that that you're not taking too much risk by over leveraging the loans that you're lending out, or the fund is over leveraging the loans that they're doing, you can mitigate your risk should you see some downward pressure on market values. So our fund, for example, we focus on lending at 65% loan to value in first position loans. What does that mean? Well, if a property is sold or refinanced, we, the lender in first position, get paid out first. In a situation where there is a foreclosure action and the property needs to be sold, again, we are the first, after property taxes and whatnot are paid, to get our money back. And so, when we talk about the security of real estate, that is what that security is that debt position. Number three is the 20% tax deduction. Anytime an investor can earn a tax deduction on the income they make, obviously they're going to be happy about that. Number four is liquidity. Now, when I say liquidity, I always want to tell people private debt funds are as liquid as there is incoming cash. So the two main ways that a debt fund remains liquid, obviously, is when loans pay off and there's a liquidity event, and then they can use that liquidity to pay off investors, or you have incoming investor capital that you can use to manage any withdrawals. At the point where you don't have any loans paying off, or you don't have any new investor capital comes in, a debt fund can quickly become illiquid. I also compare it like a run on a bank. Okay, so if you got money coming into the bank, depositors can take their money out. But if you don't have money coming in, your funds are going to be locked up for a period of time until the debt fund can unwind some of the loans that they have on their portfolio, or they able to raise third-party capital some way. So it's liquid until it's not, is kind of what I tell investors. And then there's just a huge opportunity, a growing market for private real estate debt. So our debt fund right now is just shy of 80 million. I can tell you, I would be comfortable in saying that I could probably put out another 40 to 50 million in just the Southern California market and feel confident that I can get those funds out. That's how big and how much opportunity there is in this debt space. So let's go ahead and I'm going to hit some questions real quick. First question here is, please explain what happens if a borrower is unable to sell their property or refinance with a long-term loan. Do you routinely extend the loan or not? How do you decide whether to extend or foreclose? What percentage of TaliMar Income Fund is invested or extended into loans versus new loans? So really the question becomes, when a loan becomes due, what does a normal fund manager do? So you have two options when a fund or a loan becomes due. Is a fund manager can decide, okay, we're going to extend the loan out if the borrower is making payment, or we can call the loan due. Now, most fund managers, or at least I'll say for myself, that you're going to want to do two things. Number one, you're going to want to make sure the borrower has a clean payment history. Okay, that's first step. Number two, you want to make sure that your loan on that property falls within the underwriting guidelines for your portfolio. So typically we want to be between 65 to 70% loan to value. So my loan amount is no greater than 65 to 70% of the underlying value of the real estate that property is secured on. Anything higher than 70%, you start to risk, if the property value comes down, that there isn't enough proceeds from the sale to pay off the loan. So that's number two. You want to make sure your loan to value ratio stays in. And then third is to understand why the borrower is in that position. Are they in a position to refinance it? Are they actually trying to sell it? If all those three criteria kind of fall in line, you feel comfortable, typically you're going to go ahead and extend the loan. If there's an issue, the borrower payment history isn't strong, or the value has dropped significantly, you're going to really want to push that borrower to pay off. But it's kind of a it's kind of a give and take. I mean, if the borrower's performing and you just want to slam down the hammer and say, hey, your loan is due and we're going to throw you right into foreclosure, you're usually going to create more of an issue on there if there really isn't necessary to do, to call that loan due. Hopefully that answers your question. The question becomes, for me, how many loans have extended versus new loans? We're closing on average between about 15 loans. We're probably doing one extension a month. That's probably, some months we have more, some months you just don't have any extensions. So I'd say on average, maybe 1 to 2 extensions in a given month. Now, keep in mind, extensions are not all that bad too. Typically with an extension, there is an extension fee. And in our case, the fund does profit from the extension fee and earns additional income. Equity-like return for fixed income instrument implies excessive risk in terms of proper risk diversification. Any thoughts? Absolutely. Anytime you're earning in that 8, 9, 10, 11% plus range, you are you're going to have risk. Do I say it's excessive risk? Well, it depends on, what your level of risk is. I feel confident when you're earning, when you're secured on a single family, multifamily, or other type of property at 65 to 70%, that a lot has to go wrong before you start to lose money. Again, we're earning year-to-date yield of 9.5%. Our target yield is 9%, so we've exceeded that. But there definitely is risk involved in earning those kind of yields. Next question is, how did mortgage funds or trustee investors perform during 2020 when mortgage rates were very low? How did private loans perform? Will returns drop significantly if interest rates decrease again? Okay, so this is a big question. I get this a lot. First, the question is, back in 2020, when rates were so low, how, as a fund manager, was I even raising money to earn 7%? Now, keep in mind, back then, earning a 7% fixed income on your investment was actually pretty good. It was, if you compared that with buying treasuries, you're 0.5%. If your money was sitting in a savings account, you were getting 0%. So compared with your alternative options, earning 7% wasn't bad. In terms of how did private loans perform? In general, I would say private loans performed relatively well, but then again, that depends on, as a private lender, what you were lending on. I would say that if you had a heavy exposure to office right now, or even back then, you've got big problems as a private debt fund. If you were secured on single family or multifamily, you're probably sitting you're sitting fine from a loan to value ratio. Again, as long as you didn't exceed or lend at excessive loan to value ratios. Do I see returns dropping significantly? I don't see it. I think I didn't get a chance to see the latest numbers that came out today on inflation. But I don't think that the Fed is going to be coming out and decreasing interest rates anytime soon. I know coming into this year, there was speculation of 3 to 4 drops. Or decreases in rates. I don't see that, but if you do see some decrease in rates, yeah, you're going to see a slight decrease in the return of the fund. Now, the other question that comes in is, how is is the return of the fund correlated to like the 10-year Treasury? And the answer is kind of. It's somewhat correlated. 10-year Treasury was at 0.5 point in 2020. It jumped literally 4 percentage points. For us, the return of the fund only jumped, and not saying only, but jumped 2.5 percentage points. So why did you not see a 4% increase in the private debt space like you saw in just comparing it with treasuries? Well, the answer is because the returns in the private debt space are predicated on how much capital, how much liquidity is chasing the private debt space. I can only charge so much before my competitors will underbid or provide lower interest rate loans. So my ceiling is what my competitors are doing. And for whatever reason, you just see a significant increase in liquidity within the private real estate debt space that kind of puts that yield to the investor, at least in our fund, at that 9 to 9.5% return. So correlation there is, but it's pretty loose. Good question, though. And keep bringing these questions in. So, okay, so let's talk about how to evaluate a mortgage fund. So as I mentioned, not all mortgage funds are created equal. Some mortgage funds are, focused on lending nationally, which, by the way, I'd be really hesitant to invest in one of those. It's really tough, especially as a fund manager, to be lending across the entire country. You really got to know your sub-markets when you're lending. They do it by property types. Are they focused on single family, multifamily, commercial? Do they have a high concentration of office? This is stuff that you want to learn or want to know before investing. My recommendation also is first kind of put together the criteria that you would want to be invested in. If I was investing in the private debt space, would I want to be investing in office? Would I want to be investing in land? Would I want to be investing in single family? Kind of create your kind of criteria. Forget returns at this point, right? Because if you're just simply using returns to gauge what fund you're going to be investing in, that risk for that fund could be way different than what your tolerance is for the risk. That's why I always say start with kind of figuring out what do you want to be as a private investor lending on. Then from there, identify those funds that meet your criteria. So things you want to consider is property type, single family, multifamily. Those are probably the most liquid type property types that you can invest in. And then as you get to more speculative property types, you go from single family, multifamily, probably industrial, depending on submarkets, retail, other type of space. And then you get to the riskiest, which is land. Loan position, really important. We as a debt fund only fund in first position. So again, we get paid out first when that property gets sold or refinanced. There are definitely debt funds out there that'll fund into second position loans. That means that the first position loan has to be retired before any money comes out to pay off the second. You can get considerable returns. You can get really high returns on second position loans, but is it worth the risk to be investing in those kinds of funds? Loan to value ratio, we talked about that. What is the loan amount to the value of the underlying asset? So if I've got a loan or a property that's worth $100,000, I've lent $50,000, my loan to value ratio is at 50%. So I always say that you want to stay on single family and in multifamily at 70% or lower. Some investors would say I want to stick at 65. But as you get more complex property types, or what I call less liquid property types, like your commercial, industrial land in that space, that LTV ratio drops. Markets, you want to make sure you're confident in the market that the fund is lending in. Make sure the markets that they are focused on have a high volume of transactions, that they have a supply-demand imbalance. You would hate to be lending into a market where there's just a huge supply of new properties coming onto the market, and that drives down values. That's personally why I like Southern California, because there's just such a massive supply-demand imbalance. You're never going to have a massive supply of new housing coming into these markets. That should, and I say should because obviously things can change, but it should buffer markets like Southern California from any significant decreases in values because the demand is still there for housing. And then structure. Now, every fund is kind of structured differently. When I talk about structure, is how does the fund manager get paid? We as a fund, I get paid two ways. The first way is I get paid on the front end with fees. So when I lend money out, that borrower pays us, the fund manager, a fee to get that loan, and then I take a servicing fee. So right now, the fund makes about a 10.5% gross yield. So that's the average interest rate that we charge. And then after we take our servicing fee out and the fee administration costs, so those are the third-party fee fund administrators and whatnot, the investor earns that 9.5% yield. So that 1% strip is kind of as a second component to our income. Now, there's different fund structures. A lot of some funds will take those upfront fees, throw them into the fund, and take a performance fee. It's kind of similar to what you would see maybe like in a private equity fund or hedge fund, where the fund manager will say, okay, you're going to get a guarantee, not guaranteed, but you'll earn at least an 8%, and then we split it 50-50 from there. Every fund manager has a little different way of doing it, but you really want to understand how does that fund manager make money. Number one, you want to make sure they do make money, because you don't want to get involved in a fund where the fund manager isn't making enough money to maintain their office and their employees. But you want to make sure that their interest is aligned with your interest. And that's why we created a servicing fee in our fund. So if a loan stops paying, we, the fund manager, don't earn income on that loan. So it's in our best interest to make sure that the loans that we're putting in the fund are performing, or we're just not going to get paid on that loan. Obviously, look at the current performance. Obviously, past performance is important. You want to make sure the fund has a track record of successful deals, but you also want to take a look at what is the current performance of the fund. What is the return? What does the loan have any non-performing loans? So what is a non-performing loan? Just simply that means that a borrower or a loan within the portfolio, that borrower isn't paying. Maybe it has matured or something has resulted in a default in that in that portfolio. So if you see a portfolio with a large amount of defaults, that's something that should be something that should pique your interest. Why do they have a high number of defaults? I think, in our industry, and there really isn't numbers to say this, but a private debt fund should probably stay with 5% or less of its portfolio is in default. I know for some that may seem high, but just consider the fact of, these are typically higher risk mortgages, especially that you're lending to real estate investors. So you want to try to keep it 5% or less. We're just shy of 2% in non-performing loans. I think that's 3 loans in our portfolio. So definitely check the performance on how those loans are performing in the fund. And then look at management experience. You obviously want to make sure that whoever you're investing in has experience in this market space as a lender. What you're seeing is a lot of people moving from being a syndicator of apartments and whatnot, moving into the private debt space just because the demand is there. Being that you ran a apartment syndication doesn't necessarily equate that you're going to make a good loan or fund administrator or fund manager for a loan fund. All right, so you've chosen your fund. You like the region that the fund is investing in. You like the fund manager. It's got the experience you have, the dynamics, the performance of the fund meet your threshold. It doesn't end there. You got to stay involved. You've got to continue to watch over your investments. You want to make sure that that default ratio isn't spiking. You want to make sure that that loan to value ratio moving forward is in line with what your risk criteria or tolerance needs. And then make sure that that fund manager maintains the property types that they're lending on. So those are the 3 main things that I look for, or that you want to look for in the fund performance. Every fund typically does an audit, especially if you're getting in the 10 million or greater. There's going to be an annual audit. Audits can be, and I can't bring them out because they're very thick, and again, legalese language, but you can do a cursory review of the audit and see from a third party what the performance of that fund is. It will cover non-performing loans within the portfolio. It will talk about any issues within the operations of the fund will be found in the audit. So you don't need to be a CPA to review an audit. You can just quickly review it and you'll see issues that the auditor might bring up. Also take a review of who the auditor is. There's a couple of auditors that focus on the private real estate debt space. I'd be more than happy to share those names with you. Really, you want to make sure that the person doing the audit is within that audit's within the industry. Spiegel Accountancy audits our mortgage fund. They've been in the industry for, I would say, more than 2 decades. And they're kind of one of the go-to auditors for debt funds our size here on the West Coast. Third is meet with management, or at least get on the phone. I know people with today, and especially changed with COVID, it's hard to get into an office and meet people in an office, but have a Zoom call with a fund manager and just get to learn, just get to know them. What is their experience? How is their operation run? One of the big things that I have learned moving from an individual trustee platform, so where I was funding loans and bringing in individual investors, to a fund where I'm bringing investors into the fund and lending out, is it's 2 very separate platforms. And I know you would think that, hey, you're lending money out. Shouldn't it be very similar, the operation? You're bringing investors in, you're funding a loan. Very different. It runs almost as 2 separate companies. On one hand, you've got that loan origination side where you're constantly bringing in new loans, want to make sure that they're obviously meeting your underwriting criteria, you're managing your loan staff, where when I was doing individual trust deeds, I could go out and originate loans myself. Nearly impossible now. I don't have the time to go out and originate loans myself. I got to bring in loan originators to bring in that healthy pipeline of loans. And then on the flip side, where in trustee world, those two worlds kind of mingled, because every time I got a loan, I would just reach out to my investor and put it together. Now you've got this kind of second business of managing the fund. So you're managing the investments that are coming in, you're managing the withdrawals, you're managing all the questions that are coming in about the fund, you're dealing with an audit, you're dealing with investor distributions at every month. So there's really two separate organizations. And you can outsource a lot of these functions. You can outsource your loan servicing. So for example, we don't collect payments here in the office. We've outsourced that to a third-party company. And we have a third-party fund administrator who is responsible for doing the day-to-day accounting. But even that, managing them is a full-time job. And you need to have staff and the resources to manage those two groups while managing the full life cycle of a loan, from the loan origination to the underwriting to the loan servicing to payoffs. So, in our organization, I even say that we have 9 people, and it's a very lean team. We've relied very heavily on software to manage the step-by-step process of a loan coming into the system, underwriting, closing, managing, and then also on the investor management side. 2 separate companies. So you want to make sure that the fund manager has the resources in place to manage a fund, especially a growing fund. And at the end of the day, like anything, use your gut instinct. If something doesn't smell right, numbers don't seem right, large number of defaults, don't have resources or staff, it's one person managing the whole thing. You'll be able to pick up on something that probably doesn't meet your investment criteria. A couple more questions coming in here. So let's go ahead and next question. Do you require your borrowers to have earthquake, fire, other insurance, as the region is more susceptible to those occurrences? The answer is yes, yes, and no. So fire, absolutely, though it's getting way more difficult to get fire insurance here in Southern California. That's really delayed a lot of our closings. Earthquake is not normal. And I get a lot of those questions of, do you require earthquake insurance? Unless the property is susceptible to earthquake damage on a normal, in a normal size earthquake, rarely does earthquake insurance required, and or if it is a commercial building, really not required. It can get pretty expensive when you require earthquake insurance, but definitely fire insurance, builder's risk insurance, if it's a fix and flip loan or a new construction loan, is definitely required. Okay, next question. What will the fund do if 2008 real estate crisis happens again? Good question. Property values drop by 20 to 40%. How does funds manage the risk? All right, so let's talk about what happened in 2008. That was an anomaly. Okay, so something outside of real estate, other than, when I talk about outside of real estate, how mortgage funds were being chopped up and sold impacted the value of real estate. You just don't have that potential issue. Now, you never had that potential issue prior to that. So people would say, well, why can't it happen again? I would say that the banks are, and investment banks as well, are much more positioned to not get into that issue again. Now, if you did have something like that, where the values of real estate are going to drop by 20 or 40%, any investment you've made is going to have its issues. So it's not just going to be put together in a private debt fund, but anything that you invested is going to be impacted by that. The biggest concern for a debt fund isn't so much short-term drops in value. Obviously, it's a concern. You want to make sure that that your loans sizes don't exceed the underlying value of the real estate. But the biggest risk to a mortgage fund, and I tell this to everybody, is a run on the fund. When you have a large number of investors, go ahead and try to withdraw funds. There is no way for a mortgage fund manager to get all of those redemptions out. And so you have to, what the fund manager ends up having to do is to close up the fund for a period of time until he can get a certain amount of those loans to pay off. Now, in some cases, a fund manager may be required to sell loans in order to meet those redemptions. And that is not in anybody's interest. Loans do not sell most cases at par value. So in order for a fund manager to meet the liquidation requirements of the investors, they may have to go out and sell the fund, sell that loan. So if they sell that loan for 100,000, they may only get 95,000 for that loan. Therefore, all the investors would lose a portion of their investment, being that they can't liquidate those loans. And especially if you've seen property values drop at 20 to 40%, I can guarantee you hard money mortgages are not going to be liquid. And in order to liquidate those, you're going to have to take a significant drop. So what most cases, or in this scenario, would happen, fund manager would have to lock up the fund, stop any investor withdrawals until they can work out their portfolio and get those loans paid off so they can start to make withdrawals. That's kind of the honest truth and transparent truth in that. Good question, though. What is your non-performing rate and default rate now? I made mention to that. We're just shy of 2%. And then with consumer debt increasing, what do you expect to have NPLs next year? So we don't do consumer loans. It's all investment properties. So we don't lend to the grandma that needs a hard money loan to keep her house. These are all real estate investors that we're lending to. And the reason we do that is for two reasons. First is there's a lot of consumer regulations around lending on consumer loans, especially on owner occupied. So we just stick with non-owner occupied. The other thing is that it's my belief that an investor doesn't become connected with their home. So if you're a homeowner and you're about to lose your home, you may not make rational decisions in an effort to keep your home. But if you're an investor and you've got 30% equity in this property and you've got the ability to at least save some equity, even if your loan is in default, you're more likely to go out and sell that property. I'm not going to say that's all the time, but you'll probably understand rationally you're going to want to sell that property. So I find that borrowers on the investment side who recognize that they can't make their payments, and after a quick conversation saying you're probably best scenario here is to go out ahead and sell that property or refinance us into another loan, go ahead and do that. Okay, does the loan origination fee and upfront points for the loan get paid to investors or the management team? The answer is it gets paid to the management team, or at least in our fund. Not all funds, but in our fund, the upfront fees get paid to the managers. In some funds, those fees get put into the mortgage fund. Great questions. All right, so we're coming down to the tail end of our webinar, but for those that invest in trustees, which is I'd say about 50% of our investors in our mortgage fund had invested in trustees or mortgages. For those not familiar with investing in trustees, essentially you are becoming the lender yourself, and you are lending money and your name is recorded directly on the deed of trust, which is secured on that property. About 50% of our investors came from there. Core reasons why they transitioned from investing directly in trustees to a mortgage fund, usually is diversification. The brokers that they were using to find the mortgage funds that they were investing in were retiring. With the increase in the number of debt funds, the debt funds typically attract the better loans. So what was left over for individual trustee investors was kind of what was left over that the funds didn't want to fund. Are kind of the reasons why a lot of the investors moved to trustee investing. So number one, here's a quick comparison chart of investing in a mortgage fund versus investing in trustees. Number one is security of real estate. Essentially, both options offer the security of real estate. You are secured with a trustee on a property. Consistent monthly income. Most cases, trustees offer consistent monthly income unless that trustee stops paying. Same thing with a mortgage fund. Though, because you're diversified, there's a lower likelihood that all of your payments are going to stop from a mortgage fund. Diversification. Unlike trustees, where all your money is in one trustee, In a mortgage fund, you're diversified over the entire portfolio of mortgages. So not one mortgage significantly impacts your return. Fourth, earn compounded interest. This is a big thing, and people kind of underestimate this. When you invest in a mortgage fund, as I mentioned earlier, you're able to reinvest those distributions. You can earn compounded interest. And I just did a analysis that if you were to invest or reinvest your distributions in our mortgage fund over a 12-month period, your return increased by almost a 0.5 percentage point simply by reinvesting those distributions. Can't do that with trust deeds. With trust deeds, when that borrower makes that payment, those funds go into your checking account or your retirement account, and they sit there until you can reinvest those distributions. Mortgage funds, if they're structured as a REIT, could qualify you for that 20% tax deduction on the income. Can't get that on trust deeds, get those in mortgage funds. Liquidity, if you're invested in a trust deed, you're riding that trust deed until it pays off. There may be some options of selling your trust deed, but it's low likelihood that you'll be able to sell off your trust deed if you need to liquidate your investment. In a mortgage fund, it's much easier to liquidate your investment. I'm not going to say it's completely liquid. We kind of talked about this where the liquidity of the fund is based upon payoff of loans or new investor capital, but you're much better positioned to have liquidity in a mortgage fund than you would have in a trust deed investment. The one benefit that the trust deed has over a mortgage fund is that you're recorded directly on property. So, if I were to look up at that property and it was Brock VandenBerg as the lender, my name is directly there. And so for some trust deed investors, that is the most important part of their investment, and it overrides their liquidity, tax deduction, and compounded interest options of a mortgage fund. But I find the vast majority of people that I have worked with that invested in trust deeds through us have converted over to investing in our mortgage fund. So with that, that's kind of done with the first portion of our webinar, talking about kind of the general functions of a mortgage fund. Second step here is going to talk about our mortgage fund. So people that want to stick around and learn more about our mortgage fund, please stick around. I'm going to see if there's any more questions here. Okay, question on liquidity. What is the typical lockup period for investments in the fund? What options are available if I need to withdraw my money before the end of the commitment period? So good question. And I kind of didn't get into the lockup period. So in most mortgage funds, there's something called a lockup period. So when you initially invest in any fund, that fund manager wants you to be invested for a period of time. Obviously, there is a cost to getting you invested in the fund. And then in order to kind of maintain the consistency of the fund manager needs to know who is going to remain invested. So you can imagine comparing two funds. One fund it's a consistent, investors keep their money in. And then you got another fund where investors are constantly adding money, withdrawing money, adding money, withdrawing money. You can imagine for that fund manager that's got that kind of money coming in, money going out, it's hard to kind of foresee how much capital they're going to have to do their day-to-day business investing, right? So you want to kind of maintain low amounts of income or outgoing and incoming funds. Makes it much easier for a fund manager or a fund to perform if they know, they can see what they have in terms of investor capital in the future to invest. That is why a lot of fund managers create a lockup period in the fund, and usually that's 12 months. For a debt fund, it could be longer if you're investing in a fund that buys properties. Obviously, in order for a fund manager to get withdrawals of a fund that has properties, they would have to liquidate a property, which is much more difficult than trying to wait for a payoff on a mortgage. That's why debt funds are typically more liquid than a fund that might hold real estate. So in our case, though, when I first launched the fund, we had a 12-month lockup period. And I found that, just to entice investors, we eliminated the lockup period. So technically, you could invest today and withdraw your funds tomorrow. Obviously, I don't want you to do that. I don't want you to treat our fund as kind of a high interest rate checking account. But it gives investors the comfort that, look, if this investment isn't right for me, I can take my money out. So to answer your question, most mortgage funds are around 12 months. I think the market, or I think more mortgage funds are going towards kind of eliminated the lockup period. But if you're investing in a fund, all I would ask is don't treat it like a high rate checking account, because it creates just issues in dealing with cash flow for a fund manager. If you're going to invest, invest for the long term. Is redemption on a best effort basis? So good question. So what happens when you have a large number of investors is that usually it's a first come, first serve. So first person to request their withdrawal are going to be able to withdraw their money. Now, most funds like ours do have some caveats to that. So we could technically lock up the fund and say, okay, we get a huge amount of payoffs. You investor will only get 25% of your requested payoff this quarter. We're going to then go down the list of people that have come after you and give them their 25%, and then go to the next, once more funds come in, then go back to that list up to 25%. That's put in there as a buffer so that if you have a large number of withdrawals, it doesn't impact the performance of the fund for all of those investors that wanted to stay involved in the fund. It reduces the risk that a fund manager actually has to go sell funds versus waiting for loans to pay off. And then it also, if you get a large number of withdrawals, people that are kind of end of the list do have access to their capital if you're limited it to 25% of investor capital. Now, we choose it's a first come, first serve. So as withdrawals come in, we'll process that withdrawal first, and then whoever comes after you will get their funds. But it's again, it's based upon when you submit that request. And then I look at it, we've never had this issue yet, knock on wood, but in the case where, again, we have a large number of redemptions and you have to lock up the fund or kind of spread out those withdrawals, that you communicate that to the investors. All good questions. So I'm going to go ahead and move to the second phase of our webinar, and that's talking about our mortgage fund. So what is TaliMar Income Fund 1? So essentially, as a fund, we focus on funding loans in the Southern California market. Now, we can actually fund throughout the West Coast, but we choose to fund primarily in the San Diego, Orange County, and Los Angeles markets. In fact, I think about over 80% of our portfolio, our loans are just here in San Diego County. For a lot of fund managers, that seems crazy, but you know what? We know this market. We're in this market every day. I can go out and I can go look at the properties that we're lending on. Most cases, I know the borrowers that we're working with, or we're within the same network of people. And I think that's what's really been able to mitigate or keep our default ratio levels low. We're weighted heavily towards residential and multifamily assets. Again, I think it's north of 80% is in residential and multifamily assets. And then we have an experienced in-house team to originate and manage the fund. I've been at it for 15 years, brought in 2 very qualified loan officers to go out and identify new lending opportunities. And we bring them in and fund them, assuming they meet our underwriting criteria. Very strong loan processor, reviewing all of the loans that are coming in. We're bringing on a loan closer to help manage drafting loan documents and ensure a smooth closing. And then our loan servicing team, one of the best. Over 15 years, we've really been able to identify best practices to ensure that we minimize defaults. Now, one of the big things is, people say is, well, you need to focus on loan origination, making sure they meet your underwriting criteria, which is very true. But as I tell people that invest in mortgages, that's only 50% of keeping a strong loan portfolio. You need to manage your existing loan portfolio. You got to make sure that the borrowers are making their payments. And if they're not, how are you communicating that to them? How are you getting those payments from the borrowers? Making sure that if you're coming up on a maturity, that you're working that issue out with the borrower to see if you need to extend the loan. Our fund is structured as a real estate investment trust. So you do earn that 20% qualified business income tax deduction. You need to talk to your CPA though. There are some caveats to that, and that might bump you out of the ability to earn that. But most cases, most investors will earn that 20% qualified business income tax deduction, regardless of your income. Fifth point is supported by third-party vendors specializing in the fund industry. So we rely heavily on our third-party vendors. So we use Verivest to do fund administration. They're the ones that do the day-to-day accounting. They're the ones that do investor onboarding. All of your statements that you get, that portal that you invest in, that you log into, all handled by Verivest. So they're one of the larger fund administrators for private debt funds like us. And then we use FCI Lender Services to do all our loan servicing. They're the ones that collect the payments. They're the ones that do the mortgage statements for our borrowers, year-end tax statements. They're by far one of the largest loan servicing companies to manage the private debt space. If you're investing in mortgages and you're still servicing those loans, highly recommend looking at using a third-party loan servicing company, especially here in California, where the regulations just get more and more complex and what you can and can't do. So the fund structure, I kind of mentioned earlier in this webinar how the fund structure works on a general mortgage fund. Very similar to what we do. The only difference is that we have that TaliMar Income Fund REIT. We've got that REIT in between the mortgage fund and the loans. Reason why that's important is that is what's giving you those tax benefits. Those interest payments actually flow through the REIT. Those interest payments are processed by the REIT and then paid to the fund, and then those distributions are then paid to the investor. I always like to say this: we want to be the most boring fund that you can invest in. We want every month just to provide you a monthly coupon. Okay, we want to get you to our target yield of 9% and no questions asked. There shouldn't be any significant changes in the returns that you should expect. We try to keep it extremely boring. That's what I tell investors. Hey, real quick, a couple other questions just came in. How do you ensure portfolio diversification, and what measures are in place to avoid overconcentration in specific assets or sectors? So in terms of concentration, we try to keep our mortgage fund diversified, our fund, right around about 65 to 70% residential. We're exceeded that, about 80% residential. Where we try to not allocate, or we want to make sure that we're watching diversification, is number one, that we're not overly funding one borrower. So that borrower doesn't have over 7% or 7% of our entire investor capital to any one borrower. Same with real estate. Try to keep any one loan to at least 10%. I mean, at least 10%, but we try to focus about 5% or smaller of the entire loan. That means that of the portfolio. So that means that one loan doesn't have a huge impact if it were to default on the overall return of the fund. Again, we try to stay within the Southern California marketplace is our focus, and we're looking to work with experienced borrowers. But again, and then you don't want to become overly exposed to new construction loans. I think right now we're around 3 or 4% to kind of new construction. You don't want to get above that 10 or 15%, because again, construction loans have a tendency to have a little higher risk in the loan portfolio. So we talked about boring. We want to be as boring as possible in our mortgage fund. Here's an example of the type of loans that we're funding. So a lot of the loans that we do are short-term bridge loans and fix and flip loans. So these are fix and flip. This example here is a loan that we funded on this single family home. Borrower came to us, purchased the house, renovated the house, and then sold it. These loans range all the way from 4 months to maybe 12 months, depending upon how much renovation is required. But either way, it's super short term, and the borrower is adding value to the real estate, and that there's a clear exit strategy. So borrower intends to renovate the property, so they're improving it, and then they're selling it. So there's a clear exit strategy. So I look at worst case scenario. Let's say I have to foreclose on that property. Well, at least I have a fully renovated house, assuming the borrower finished the renovations, is the property that I would have to take back in, in a worst case scenario compared to other scenarios, such as a house that wasn't renovated or a commercial property. I would much rather take back that asset class. Example now here, another fix and flip loan that we recently funded up in Petaluma. And then here was a little retail loan that we did on a strip center. Strip centers get bad raps in the media, but here in San Diego, still high demand for retail strip centers. The thing about these, which is nice, is that a lot of, especially small and regional banks, again, we're usually the ones that were lending on these types of properties, aren't lending like they used to. And so that's kind of left this big open availability of funding these kinds of loans. This is a before and after. And I used to be able to do a video here, but I can't. What I wanted to provide here is an idea of kind of what a property would look like after or before we funded it and after we funded it. You should go to our YouTube site, TaliMarFinancial.com, and check out all the before and after videos that we do of projects that we have funded. It's quite interesting or quite spectacular how our clients go in and just fully renovate these properties. So we have an experienced team, and right at the top of the list, our legal team is Gerasi LLP. They're the ones that did our fund documents, and they continue to guide us from a legal perspective. Fund administration is done by Verivest. So they're the ones that do the day-to-day accounting, the month-end accounting. They're the ones that put your statements together. And again, they're the ones that put the portal together that you log into to view your investments. Tax and audit work done by Spiegel Accountancy. We're wrapping up our 2023 audit. We'll go ahead and post that on the Verivest site here shortly. We should be done within the next 2 weeks. Loan servicing done by FCI Lender Services. And being that we are heavily dependent on software in the day-to-day processes, BitCot is our software development team. Target loan portfolio positions, first trust deeds. Target LTV ratios at 65% or below overall. I think we're around 64% loan to value right now. Target location is California, plenty of opportunity in the San Diego, LA, and Orange County markets to be lending. Focus on property types such as single family, multifamily, and some commercial. Very low exposure to office. I think I got some graphs here that I can show you. Loan types, fix and flip, bridge, and new construction. Now, we never really done a lot of new construction. And I say that, or I use new construction because we're doing a lot of ADU builds now. So borrowers buying a single family home and building maybe 4, 5, 6 units in the backyard. Very popular here in San Diego, where the city is trying to bring in more housing. So what you're seeing is a lot of investors buying up these single family homes that have large lots and maybe alley loaded backyards. So they got a street running or connecting the backyard. You're seeing a lot of new construction for accessory dwelling units there. So we're seeing a lot of volume from that perspective and had a lot of success with those loans. Loan size not to exceed 10% of investor capital in the fund. So again, any one loan will not exceed 10% of the total balance of the fund. Loan terms, we're really keeping it to 12 months. We'll go as long as 24 months. But the problem when you start to get longer term loans is that you do take interest rate risk. And so if you were holding long-term debt prior to the recent increases in interest rates, you've got a lot of debt in your portfolio that probably is below market interest rates. So we try to keep it short term because you don't want to get caught in that scenario. Minimum credit, 675 or above. We want to work with experienced investors with strong credit. We find that credit is one of the biggest predictors of how a loan will perform. If a borrower has lots of late payments in their credit history, they're going to have a lot of late payments in your fund. And just like a bank, I'm not interested in trying to put a large number of non-performing loans in my portfolio just to earn default interest or late fees. I'll tell you, it costs a lot more just to manage a portfolio that has non-performing loans in the portfolio. Question here, for fix and flip loans, does TaliMar manage Dutch loan or non-Dutch interest? Does TaliMar Income Fund use leverage or a line of credit? And if so, how does leverage get applied? So let me answer the first question. Dutch interest or non-Dutch interest? Essentially what that is if you're charging interest on the construction holdback. So let's say I fund a loan and that loan is a $500,000 construction loan. And at close, I've not deployed any funds yet. The borrower has not asked for any funds for the construction. I am not earning any interest in a non-Dutch loan on that loan. And so I only start to earn interest once that borrower takes money to fund construction costs. So let's say day 2, he takes 100,000 of the 500,000. I'm now charging interest on that 100,000. For fix and flip loans, it's not common to have non-Dutch loans. So on fix and flip loans, I may have an allocation of 100,000 that I'm holding for the borrower and dispersing to them over the course of the construction. That in most cases is going to be Dutch interest. What's great about that is that I can charge, we're earning interest on money that we haven't put out. We could technically put that money back, lend that money out on another loan, and you start earning double interest. Again, you can't do that on trustees here in the state of California, but if you are and I'm getting into the weeds here, if you're a CFL licensed lender, you can do that. So you're earning interest on a holdback. Now, non-Dutch interest comes into more in the fact if you have very sophisticated borrowers who are building larger projects, so like ADUs or have huge construction budgets, and they have access to more conventional bank financing where you're not charging interest on that construction holdback. I know, again, I'm going to the weeds here. So my answer is this. On normal fix and flip loans, it's Dutch interest. On larger construction loans, maybe like ADU builds and that type of stuff, you're really getting into the non-interest in order to be competitive at that marketplace. But what you're giving up by not charging interest on that construction holdback, you're getting a much more seasoned seasoned borrower, higher credit, much more experienced. Do we use leverage? And I'll get into this in a second. Yes, we have a credit line of 5 million on the fund. So we're about 80 million in the fund. We've got 5 million. I didn't really get into this in the earlier part of our presentation, but essentially what a credit line is a fund manager can borrow from a credit line and lend that money out to fuel the growth of their loan portfolio. When interest rates were low, this was a great option. You could borrow money on a credit line at, let's say, 3%, and you could lend it out at 8% and make a pretty good return on that difference. Now, though, banks have increased, because interest rates have gone up, have increased what they charge on their credit line. So for us, we get charged 9.25% on our credit line. Well, the investor is earning a net yield of 9.5%. There isn't that much of room there to really make any income from that. So leverage now is used more for a function of cash flow. So if I've lent all the liquidity out in our balance sheet on loans, I get a new loan that comes in that I want to fund, I can tap our credit line to use those funds short term to fund that loan, pay down that credit line from other loans that might be paying off in the near future. Also use the credit line if we get a large number of construction draw requests. So we talked about holding funds back. I can use that credit line to fund those construction draws. But at the end of the day, we're not using a credit line as a way to boost investor yield. We're using it more of a way to manage day-to-day cash flow. All right, so currently in our portfolio, we have 104 loans totaling 83.67 million. Average loan size is around 800, a little over 800,000. Weighted average coupon. So this is the average rate of our portfolio. Now this takes into consideration some legacy loans that are still lower yield. Is at 10.138%. Average loan to value ratio on our portfolio is just shy of 65%, right in line with what our target LTV ratio is. Average term is around 13 months. Fund overview in terms of our loan type in our portfolio. 57% of those loans are bridge loans. We qualify bridge loans as the borrower isn't intending to add any value to the real estate. They just need a short-term loan to purchase the property or refinance an existing loan. 30 or about 37% are fix and flip loans. These are where borrowers are buying a property to renovate it and then sell it for a profit in the future or refinance it. In those cases, we usually have a construction holdback that we hold on behalf of the borrower and then disperse those funds over the course of the project. They're not really classified as, I don't classify them as construction loans because you're not doing like brand new ground up construction. Usually you're just redeveloping an existing structure. That makes about 37%, and construction loans at 5.8% of our portfolio. Now, we qualify new construction, not just generally vertical construction, but if the borrower is putting a large, ADUs in the back, we're starting to include that as new construction. But it's not something where we're going out and doing a lot of actual new construction, building on a new lot. Fund type, someone had asked earlier, do we get over diversified or in any single asset class or over concentrated in an existing asset class? We like to just stick with SFRs. Again, that makes SFR and multifamily combined, that makes up about 80% of our portfolio, with the remaining 20% being between industrial, commercial, and other property types. Location, again, heavily in San Diego. It's our backyard. Huge demand for private capital just in the San Diego marketplace. We did bring a loan officer in to target the Orange County and Los Angeles market. So we're looking to diversify into those two markets. Fund returns. We've been able to be pretty consistent over the last, through this year, right at 9%. We're actually targeting 9% for this year. Currently, we're year to date at 9.5%. Right here, what you see is kind of comparisons of other fixed income investments. You've got your S&P bond index, and you've got your 10-year treasury note. So typically, we're a little low, almost 5% greater than what you would normally get in a 10-year treasury. And then I think it was like 3% above what you would get in an S&P bond index. Nice thing about our fund is that you're not taking equity-like risk when you're investing in these two asset classes. Fund size, we've been pretty consistent in our growth. We bring in about $2 to $3 million a month in terms of new investor capital. It's pretty good for us to just deploy about that amount of capital every month. Ways that we strategize to mitigate our risk. Number one is that we just know our markets and know our borrowers. We talked about earlier that we're not a fund that we try to go national in deploying capital. It's really difficult to know your market and your borrower. But if you stay very hyper-focused in your markets like San Diego, Orange County, and LA, you can really minimize issues with your portfolio because you can really gauge what's going on in those markets. Focus on strong property types. So we talked about SFR and multifamily. Most liquidity of those two are the highest of those property types. That's what we try to stay consistent with. Loan strength over portfolio yield. Yes, there are other funds that may earn a higher yield. We prefer to keep a stronger loan portfolio and minimize defaults than try to chase higher returns. We feel that where our risk-adjusted return are right in line with funds that are focused in the Southern California market. Take a very aggressive approach at loan servicing. Not only have we outsourced the actual day-to-day servicing of our portfolio, but we have a dedicated person to ensuring that borrowers are making payments on time, that if the loan is soon to mature, that we're reaching out to our borrowers, and that we're making sure that our borrowers are progressing through their renovations or new construction. We really rely on technology. So we've developed an in-house software proprietary to our company that essentially manages the day-to-day operations. And it really helps us to identify issues early. So, if we find that a borrower isn't progressing through construction, that's going to be noted in our software. If we anticipate some upcoming maturities or whatnot, that's all going to be, we're going to be notified through our software. And then last and most important is the communication with investors. We recognize the strength of our mortgage fund is really based upon how confident our investors are. And you can have as a high performing of a fund or a very strong performing fund, but if you're not communicating to your investors and they're not feeling confident with their investment, that can create real issues in the fund. So if you're not already on our email distribution list, highly recommend that you do that, get on our email distribution list. I usually get out an email every Friday about kind of updates for that week or that month or that quarter. We have just released our Investor Insights magazine for this month. If you're not on this, definitely not on the mailing list, get on it. All of our existing investors, you are on the mailing list, but if you're not an existing investor and want to get on it, it's great. In here we have a ton of articles about the private debt space. We highlight some of the investors in our mortgage fund. Some of our vendors actually write articles for us. So for example, Spiegel, our auditor, highlighted here in the magazine. And then we had a great article written by Marcus Carter over at La Mesa Fund Control. They do fund control for debt funds like us, are in here. So if you're not signed up, I'll send an email out to everyone who participated in the webinar today and give you a link to sign up. But it's a great read. And Adela in our marketing department spends a ton of time putting this together. We put it out on a quarterly basis. Last, I'm finalizing our webinar here. Name of the fund is TaliMar Income Fund 1. Fund type is a mortgage REIT. Structure is, so the return structure, as I mentioned before, we take a 1.15% servicing spread out of the gross yield of the fund. That's how we earn money out of the fund. Target yield is 9%. Distributions are done monthly. You have the option to reinvest distributions and earn compounded interest. Again, management fees, there's really a loan servicing is 1.15%. We do use leverage. We've got that $5 million credit line with Endeavor Bank, and we use it for cash flow purposes. And the expense ratio above that 1.15% is about 0.325%. So that's what's used to pay our fund administrator and other vendors to manage the day-to-day operations of the fund. Do you need to be an accredited investor? The answer is yes. Remember, an accredited investor is you have to have a net worth of $1 million or greater, or make a minimum income threshold. Susan in my office in the investor relations group will be more than happy to provide you the details on being an accredited investor. How much does management have invested in the fund? I have a little over $925,000 of my own cash invested in the mortgage fund. Can I invest through Schwab, TD Ameritrade, and other brokerages? And the answer is yes. Actually, TD Ameritrade was bought by Schwab, so it's really just Schwab. And then you can invest through now your Fidelity account as well. So you don't have to move your investments, either if it's a personal investment or IRA funds, off those platforms. You can actually invest directly on those platforms. For more information, talk to Susan in my office, and she'd be more than happy to walk you through that process. Are all investors eligible for the 20% qualified business income tax deduction? Answer is again, yes, but you need to check with your CPA. There are some caveats to that, and it has to do with if you've sold property within the year or whatnot. So being that we are a REIT, income is not capped on that 20% tax deduction, or your 20% tax deduction is not capped on income. Real quick here, another question came in. Will the attendees receive a copy of the recorded webinar? The answer is yes. We'll go ahead and get that out of the webinar by the end of the day. All right. Okay, so how do I withdraw funds? We kind of talked about this. First step is you would submit a withdrawal request, and then we would put you in the queue. We don't get a ton of withdrawal requests. So historically, we've been able to get those funds out within 30 days, if not sooner. But just keep in mind that the fund is only as liquid as there are loans getting paid off and investor capital comes in. So if we have a large number of withdrawals at any one time and you don't have a large number of loans paying off, there may be a lag time of getting your funds back to you. So that's why I always tell investors, don't invest funds that you need the next day, because getting a withdrawal may take longer than that. How do I get started investing? It's really simple. We'll go ahead and send an email out thanking all the investors for participating in our webinar. On there, you'll just have a quick a new account setup form that you do online. It'll take you about 5 minutes. Once that's completed, we'll go through the accreditation process, make sure that you are an accredited investor. Third is then have you sign the subscription agreement. And then once you've signed that subscription agreement, you'll go ahead and deposit your fund. Why TaliMar Financial? As we wrap it up, number one, we have 15 years of experience in the industry, consistent track record of not only getting investor returns, but returning investor capital, which is most important. We've developed internal proprietary software that really kind of manages the day-to-day operations of the fund. That allows me as a fund manager to be anywhere in the world, and I could be managing the fund. We rely on third-party subject matter experts, especially for fund administration and loan servicing. And we really focus on core property types in urban markets with strong borrowers, so core urban strong. And that has really historically been, I feel, the reason why we've had such a low ratio of non-performing loans in our loan portfolio. Education, accreditation, and verification. As I had mentioned, I was an accredited fund manager through the Jurassic LLP fund accreditation program. It was a great program to go through. Gives you a lot of insight into how to effectively manage a mortgage fund. But we constantly are looking for ways to educate ourselves on just being better at what we do. And lastly, management is invested alongside you. So I invest in this very fund, so I'm invested alongside you as the manager. For more content like this, we post a ton of great content on YouTube, LinkedIn, Facebook, Instagram, not TikTok yet, but YouTube. If you want to sign up for our YouTube page, go to talimarfinancial.com, subscribe to our YouTube page. We post a ton of cool stuff there, not only educational topics, but some of our before and after videos of projects that we have funded. We also bring in outside industry experts for webinars to talk about either legal, loan servicing, other things that pertain to the private debt space. With that wraps it up. We went a whole hour and 45 minutes. That was one long webinar. Those participants that are still on, thank you for sticking it out with me. For those that ask questions, thank you so much. If you're interested in gathering more information about the mortgage fund, feel free to reach out to me. Here's my email address right there, bvandenberg@talimarfinancial.com, or give us a call. I'd be more than happy to talk to you about our mortgage fund. You can also go to our website, go under the investor tab and request the executive summary. There we'll have all the details about the performance of the fund, all the details that we talked about in the webinar today. And if you have any questions about investing in trust deeds or mortgage funds just generally, feel free to reach out to me. I love talking about this topic. So with that, I'll let you go. Enjoy your day. Thank you for sticking around and listening to our webinar today.